Now, gaps are actually, rare things. That's why they make a great trading opportunity because, something unusual has happened. There's been some significant event or significant news and it's caused a gap in the prices. And a good way to identify it is first understand what it typically there is, and that is there's no gaps. When you look at, let's say, this chart like this, you'll see, our opens and our highs and all that, but really we're looking at the trading range of the highs and the lows. And you can see from the trading ranges, whether it's an up day or a down day, there's always an overlap from the day before. Even where we have that big spike on the right-hand side, it opened much higher. There was actually a gap at the opening where that left tick mark is on that really spiky red bar. But then the prices came down to kind of overlap again from the previous day. And then it goes on, so on from there. So there is some type of overlap when there's no gaps, and that's actually very common. What we're looking for is a situation where those ranges don't overlap at all. That would be a gap situation. So if we look at this example here, you can see like days 1, 2, 3, and 4. And these could be whatever time periods you want. If you're trading on minutes or hours or however your trading time frame is, we'll just use days here to keep it simple. But in particular, you're really looking at those closing, open and close prices. That's really more of the classic formation of a gap is looking at an overall days trading range. And so days 1, 2, 3, and 4, you can see there's overlap between each of the ranges of bars. I don't have the open and close in here because that's not important when you're looking at a gap. You're looking at the range from the high to the low. And there's overlap from days 1 through 4. But then on day 5, there is a gap. You can see that there's a space in between the highest high of the range from day 4 does not even, there's a gap between the lowest low on day 5, so there's no overlap between them. And that would be a gap situation. Now, you can identify a gap at the start of a day because by nature, for a gap to occur, the opening is going to have to occur somewhere in a void, somewhere above the trading range of the day before. So you can say, oh, something's going on here by the opening. You need a gap at the opening for sure. But you cannot measure a gap until the day is over because it could open as a gap, but then let's say in this example here, the prices actually fell and that bar got longer on day 5 going downward where there was overlap. If there's any overlap at all, there is no gap. There has to be a gap in terms of no overlap. That's the key thing to take away. So that's why you can't tell until the end of the day whether there's a gap situation that occurs, and then we're going to need to wait a little bit longer, as you'll see coming up, to confirm that gap, and that is a trading opportunity. But for now, no overlap. It can open, it can open in a gap situation, has to close in a gap situation. And we're really looking at the highs to the lows. And so you're measuring from yesterday's high to today's low. It would be an example of an upside gap. There's a space between yesterday's high and today's low. Or from yesterday's low to today's high, where there would be a downside gap. So gaps can be either going upward or going downward. And the difference is between, again, the bars highs and lows, not the opens and closes. So just really when you're looking at the gaps, you're really looking at that trading range of highs and lows. So if you're going to look at this example here on the right, what would you think that is? Is that an upside gap or would that be a downside gap? Kind of looks at it like you're going upward, so if you guessed that, you're right. But yeah, yesterday's high, it does not match up to or does not overlap today's low. So there's a gap in between the two. By the same token, if we looked at this image, you'd see a downside gap where yesterday's low does not overlap today's high. There's a space in between them. And so there's either a downside gap or an upside gap. Gaps can be either way, either up or down. And what you have going on here is you have a void. You have this space, and what's going on is there's no match of buyers and sellers. There's no matching of somebody looking to sell or buy at a certain price range within that gap area. There's a gap between the two price ranges between the 2 days. In this example here, prices had to go upward to form a match. So there might have been people trying to sell just a little bit above the day before, or maybe even below, or right somewhere within the range of the day before. But something happened, either some good news or something that triggered where everybody's saying, no, I'm not gonna sell that low. You're gonna have to pay more for me to sell. And so the prices rise, and you can see a gap there between the 2 days. So there might have been some really good news overnight that had caused the price to jump up. and create the gap. That's what's happening. Like in this example, it could be the opposite in a downside gap. In this upward gap, you can see there's some news overnight. Prices jump right up, right even before the opening, and the first opening, bid, or so to speak, or trade is well above the overlap range. There's a gap in between. So that's how you kind of understand gaps, and what you're looking for is you're basically looking for the space and this void between two trading periods, or between the 2 days.